We in the building once again. Porter vs. Prada. Don't know what episode this is, but I'm feeling good. I'm ready to go.
Yeah.
I'm ready to talk about more money. You know what I'm saying? Because I'm always the poor one in the circle. We always have multi-millionaires coming through, making me feel shorter than I already is. All right? And Prada, say hello to the people. What's going on?
We here, man. Back episode 7 or 8. One of them.
Don't know the
it's
episode,
been an amazing
but we
week.
here.
Yeah, we here. We got the beautiful Lindsey Smith.
Yay.
I appreciate that.
Entrepreneur Lindsay, number 1
insurance.
There you go. There she go.
Oh, he got
There she go.
There we go. We got sound. We got sound.
Yes. Yes. So, what's your official title? Let me not mess it up.
So my official title is Lindsey Smith, the agent.
Okay.
And we're gonna say that I'm a life insurance agency owner.
Ooh. Oh.
/ life insurance agent, where I take care of the people.
That's right.
Nice.
That's right.
Nice.
That's fire.
So Prada, how did you? Because you're the one that put me on to Lindsay's world.
Yeah.
How did you discover?
Yeah. So I'm new to Lindsay's world too. She's official. And the way I met Lindsay was actually the first time I met Lindsay was InvestFest. Yes. It was InvestFest. And she's like, hey, you the guy that
ran down to him.
Like, you the guy that got my reel going crazy. I'm like, yeah, okay. Because we did the whole life, versus I think IUL post at the time.
Right. And
it was right up her alley. Mm-hmm. So, they did the Instagram remix, and then boom. How many views did you get on that reel?
4.9 million.
So
it
basically
went viral.
So let me break it down for the people out there. See, this is what I do, Lee. Right? This is what really happened, right? So, I probably helped Prada curate a post.
Sure.
We shot the post. We posted the post. Prada's already the man online.
Mm-hmm.
Exactly.
It was probably about insurance, of course.
Directly related.
Right.
Mm-hmm.
Lindsay happened to see it, but like, wow, this is cool. I agree with this. I'm going to do a reel with this and put it there. So Lindsay really owes me and Prada 7% of her company. I'll take 3.
Yeah.
I'll take 3%.
I love how you come up with these numbers, but okay.
Lucky number 7.
I'm not mad at you.
He's not the best with the numbers, so sometimes they go wacky, but he's got good intentions.
I shoot high. So okay. Can I begin with some insurance questions?
Absolutely.
Okay.
Let's go there.
This is insurance for dummies when it comes from me. Okay. I was just speaking to an insurance agent downstairs.
Okay.
All right. I was very confused. Okay.
There's a lot of agents that will make you confused.
Right. And I think it's confusing overall. So we're talking about life insurance, correct?
Exactly.
Okay. I'm just taking step by step. Okay. Life insurance. First things first. This is something every human needs in our country, correct?
Every single one.
Okay.
Soon as you're born.
Soon as you're born.
Soon as you're born.
Okay. Explain that.
So soon as you're born, you're a human. And life insurance is protecting your human capital. So soon as you're born, you need to be protected. Risk management.
You're protected by you getting life insurance or your parent getting life insurance that you're on?
So your parent is going to purchase the life insurance because you're 0 years old with no money. But this is going to start your net worth. So if your parent purchases insurance on you as soon as you're born, then you already have a net worth. Because when you die, you're immediately going to have that amount of insurance as your net worth.
Even if you don't have anything else in life.
But Lindsay, when you die, you're dead.
But you have a family. And so you're going to leave a legacy.
Legacy creator.
Right?
Legacy.
So you're going to leave a legacy behind by being able to leave that money behind to your loved ones.
And I guess this is how you build your legacy, right? Because so with the section of insurance we're talking about right now, this money's not for you. It's for your next up.
So actually it's 2 parts to it.
Okay.
Right? It's dual. So it's going to give you money while you're living because it's a living asset. Because if you're purchasing insurance on somebody who's just now born, it's going to be a permanent policy. So we're purchasing a policy on you. You would be the insured. Your parent is just the payer. Right. And they're going to own it because right now you're a minor. So currently at this point, you actually have an asset that's being built because the money in the policy is essentially yours. Now your parent will own this money currently right now, but you can use it. So that's money that you have built that you can use while you're alive. And then the second part to it is that now when you die, your family receives the death benefit. So whether you die unfortunately young and your parent ends up receiving the money, or you die how things are supposed to be later on and you have a family, now you have changed the beneficiaries to not be your parent any longer, but your children and your husband, and they receive this money. So that's why you say it's generational wealth, because I received the wealth that my parent purchased something I now can use. And also now my parents, technically their grandchildren, are going to receive the money from the death benefit.
That's a great question. Let me jump in right there. So if I am a parent of a child that I purchased the life insurance policy for, who at that point is the beneficiary of that child's policy?
So you as the parent are going to be the beneficiary.
Okay.
When you initially get the policy.
Sure.
Because the child is not able to choose who they want to be the beneficiary.
Right.
Once that child is no longer a minor, you can sign that policy over where the child, well, they're no longer a child. When they become an adult, you can now sign that policy over to them. They now own it, and now they're in control of the capital in that policy.
So when you say you could use the money, so you're paying into this life insurance, and we'll talk about the different types, right? So you're paying into this. I guess we should start at the different types before we say that, right? So there's term,
yes,
which means it's for a certain amount of time, then it ends, and
temporary policy,
right? So let's say it's a 30-year. You pay for 30 years. If something bad happens, that money goes to somebody.
Risk management,
right? But after 30 years, it's just over.
Exactly. Unless you have converted this policy. The goal of term, essentially, is for you to have it as a placeholder. So as your income is growing, you are now converting this policy. As you're making more, you're converting more. So more and more of it is permanent. If you do it the way it's really supposed to be done, by the time the term ends, you have no more term left. You have converted the entire policy. Now, if your income does not allow you to do that, because you're not able to afford it, you will have converted the amount you can afford. And when the term ends, you now will have that portion in permanent that you converted. So let's give an example. If I buy $1 million policy and I'm 30 years old, and over the course between 30, and I have a, let's say 30-year policy, right? So it's going to go until I'm 60. So if over the years, I keep converting. I convert $250,000 when I'm 35. I convert another $250,000 when I'm 40. I now have $500,000. Let's say I never convert again. The 30 years ends at age 60. I now have $500,000 in permanent. So even though the term fell off, that other $500K, I have $500. But remember, it grows. So if I have $500,000 at 40, over from 40 to 60, the $500,000 may now be $1 million. So I actually didn't really lose anything, right? Because I got rid of the term, but my whole life grew. So in the end, essentially, I do have $1 million, or I have more than $1 million, and I now have cash value.
Is that something you could automatically do, have it set up, or you have to be intentional and tell your agency or your agent that I want to convert every 10 years, 5 years?
So you have to either let your agent know. If you have a good agent, they're going to be reaching out to you to convert. And so what I typically do is I have an email that goes out. Anybody who has term under me is going to receive an email that says, hey, do you want to change to make your policy permanent, right? Because you got to keep putting it in somebody's mind that this is temporary. Because I'm going to tell you this, the average person is going to get insurance, especially a term policy, and just say, I have insurance. That's it.
That's what I got,
they
and that's
know
what I do.
They don't know what type they have. They don't know if it's going to last. They don't even remember who they have as a beneficiary.
That's me.
They've had multiple
Well, I know
kids.
the best. I don't even know the company is with.
Exactly. And so because of that, they're usually not going to convert. They're going to find out when they receive the letter about 6 months before it's going to end, and they're going to be like, oh, shoot, I'm about to not have any insurance. And they're going to go to renew a level premium term, which is going to change their premium. If they were paying $50 a month, they're now going to be paying $600 a month on a renewal. The renewal is insane. It is not meant for you to keep a level premium term policy after the term period.
So how do you convert?
So to convert, really what it is, let me explain what conversion is. So first of all, conversion just means that you do not have to do the medical portion of getting a policy when you're getting a new policy. You're still going to have the cost at the attained age. So if you're 30, your cost is still going to be based on you 30, even if you got your policy when you was 20. Okay? The conversion just allows you to not have to go through the underwriting process. You're still going to have to pay a new bill. You're still going to have to go through the process of a new application, but you won't have to qualify medically. So what does that mean? That means the person whose health changed, who no longer qualifies for insurance, needs to take full advantage of this conversion because they may not have the option to get insurance, period. So they're going to need to do it. So locking in your insurability from having a term policy is key. If you purchase term when you may not be able to afford the permanent insurance, you still can lock in that insurability so that you know down the road when you do make money, you can convert this policy. And converting, again, is just the health portion.
Yeah, but you keep saying when you do make money. So what's the cost of conversion?
Whatever your age is at that time, your attained age, whatever the policy costs at that year that you're getting it. So you're not saving money as far as what the cost will be. You're saving your insurability. And that's very important because you have people that unexpectedly their health turns. They get cancer, they get high blood pressure, anything happens. Right? And age has nothing to do with that. I've had kids that have become uninsurable from being in a bad car accident. Right? So it's really important that you have some sort of term policy to lock in insurability if you're not ready to step up and get the permanent policy just yet.
And that's what you meant by as soon as you're born.
As soon as you're born. Because that's going to be the healthiest you are. Hopefully. Because there's some people who are born uninsurable. Because you know,
there's people who are born uninsurable.
Absolutely, because especially when people are born as a preemie or they're born and they're in the hospital, the insurance company's not taking that risk off the bat. They want to see history, so now they're going to want to wait. So you're hoping you have a healthy child, and if you do, you should get the insurance immediately.
Whoa.
So they're going to come out, because I know when I did mine a few years back, maybe like 15 years back when my mom did hers and she put me under, the agent came to the house. Mm-hmm. He took blood pressure. He did all kind of like little mini physicals right there in the house. Mm-hmm. And you're saying they will come out to your newborn baby and do a physical? So
kids do not have to do a medical. Okay. So that's the beautiful thing about getting insurance. But I want to be clear. Just because they're not doing a physical, they are still getting underwritten. So they're still going to get a prescription check on those kids. They're still going to get doctor records if you're going for a certain amount. So typically companies, when you're doing $1 million or more, they're usually going to get your doctor records. So a lot of people, you'll always hear say, oh, I want to get the insurance, I don't have to take a medical. I'm like, that may not be in your favor. Because if right now you're healthier than you were before, you taking a blood test is going to give you better results than if they have to get your records that show 5 years ago you were sickly in the hospital. They may not get your records if your current health shows up good when you do the medical. They may not need to get your records. So it's not always great to say, I'm going to go for the insurance company that doesn't make me do a medical. You're still being fully underwritten, if not even more. They're going to call you and do a questionnaire that they're going to hold you to. Meaning if you're lying on that call.
That's what I got. Yeah, questionnaire.
Right. But if you're lying on that call, they can use that against you when when it's time for a payout. They'll say, wait a second, this guy said he has no high blood pressure. It's showing here that he does. We might have not issued this case. We may not want to pay.
That's
right?
crazy. That's
so
crazy.
you have to be careful.
But what if I didn't have high blood pressure when I did the questionnaire?
No, so that's fine. They're going to know because in your records it's going to state. So if they ever want to do an investigation, they're going to get your records. Your records is going to be time stamped. So they're going to know, okay, the questionnaire was today and you found out that you had cancer five years later. Okay, well then it's nothing for us to discuss.
Right.
But if they look at your medical records and it's like, well, you did your questionnaire today and you found out 10 days before that, this is a problem. But most companies' contestability period is 2 years or 3 years. So usually after that period, they're not going to investigate anyway.
Okay. So everybody needs it immediately.
Immediately.
And
on demand.
Do you know the numbers? How many people actually have it?
So they say about 76% of people don't have it.
Wow.
Right? So which is really unfortunate numbers, because that's basically saying if we got 10 people in the room, you got almost 8 people who don't have insurance.
Not even term?
Nothing.
So everybody got $1,000 iPhone and nobody got $30 term?
Yeah.
It's a lot of people who are uninsured. And the thing about it is a lot of people are counting on their job insurance, right? That's a big thing. People are like, I don't need insurance. I got my job. But these jobs are laying you off left and right. When you retire, you may no longer have that policy. Now, I'm not saying that all insurance policies that you have through your job do not last, because there are some insurance you can get where agent comes in and signs everybody up, and you actually get to take that policy with you when you leave the job. But if somebody did not sign you up and they're just taking money out of your check and you're actually have a policy from a company, like it's like MetLife has the policy, right? If it's not that and you have a group plan, when you retire, you're not part of the group anymore. So you don't have it. So guess what? Now you're 60, 65, 67, you got health issues, and now you don't have insurance. You start from square one. It's a disadvantage because now, because of the cost, you're going to get a small amount. This is why our community has $25,000, $10,000 policies, and the family is struggling. So you die and you get a $10,000 policy. What does that do for your family? We barely could. You can't even pay the burial.
Right. That's crazy.
Right? So there's so many issues with that. So we have to stop thinking, let's wait to the last minute. Let's get the cheapest amount of insurance that we possibly could get, because that's setting our whole community back.
Not that I'm condoning any type of violence or anything, but imagine if all the black families in Chicago had life insurance.
Just imagine if
all the blocks would be rich.
They'll be lit.
Or the killing would stop.
One or the other.
Right, one or the other.
It might go up. Like, oh, I need this legacy.
We need more ammo.
Listen, before we go too far off with the businesses or the companies giving the employees life insurance, it was a big thing about Walmart putting life insurance policies on people, and once, like you said, once you leave the company, you don't benefit anymore, but Walmart still benefits when you die or whatever happens. So what do you think about that? And I mean, for me, I have my own thoughts about that, but I want to know how you feel about that.
So I think that a lot of corporations do it, and usually I feel a way about the fact that when I leave the business that you still keep the insurance on me. But it's a catch-22, because the other side of it is when they're getting the insurance on you, they're also giving your family money typically too, if you were to die while you were still an employee. Right? They're also paying for it. So I'm not paying for it.
Right.
So I understand that I'm giving a little to get a little, right? Because if I stay at this company and I pass away, they end up giving my family money that I never paid for. When I leave the company, they kept the policy. Am I happy about that? Not really.
Right.
I feel like they should transfer it, because some companies, when you leave, they transfer the insurance to somebody else. And so then they're not still getting, they don't still have a policy on you. I do feel that my family should still get something.
I feel you.
Right? That would be fair.
Yeah, it would be fair, but like you said, we paying for it. I'm just trying to figure out how I could put life insurance policies on different people.
That you don't know?
That I don't know.
Like you could just put a life insurance policy on a random neighbor.
Like
your neighbor
illegal.
looks like he got like
yo, I see this dude. He's doing too much. He's speeding out here, man. Let me put a plan on this brother right here. Let me hold him down.
You said that's illegal?
Well, that would be illegal. So
why is that illegal?
So you have to have insurable risk, right? Because otherwise, everybody who has money would find people to put insurance on.
I got a good one for you, Liz.
Right. So typically, there's actually a question on the application asking, is somebody...
Did somebody force you?
No, they want to know if somebody is paying for your insurance, for their benefit, right? Has anybody asked you? Because people will do that. Mm-hmm. There's companies that will do that they'll come and they'll say, okay, I'm going to pay the insurance. You'll get 30%. We'll get 70%. But there's no insurable risk. It's just that I'm able to pay for this insurance. So it's unfair. It preys on people who don't have money. Because who else would want to do that? I'm not giving it to you. I'm going to get it myself and my own family.
Wait, I'm a little lost. If you get life insurance, you get a policy, but that policy is if something happens to you, money goes to someone else. You're saying you can't get a policy, you can't pay for somebody else's policy. Is that what you're saying?
I'm saying it has to be an insurable risk. You can be the payer for somebody else's policy and then be the beneficiary as well, but the insurance company wants to know the insurable risk, which is why when you get a policy, they say, well, who is this to you? Is it your aunt, your uncle, your whoever, right? So
it's someone very close to my heart. The girl out the window I've never talked to, but the emotion she gives me makes me feel like she's family. That doesn't count?
No.
They're going to send an AI.
So, but on paper, legally, does it say it has to be this group of 10 people? Your mom, dad, or...
It says it needs to have an insurable risk. It has to be. So I have gotten policies declined because you've had people who are actual family members trying to buy policies on others, and the insurance company is like, well, you can't own it. You could pay for it, but that person has to own it, and then they can choose whoever they want as a beneficiary.
Oh.
But that makes you as the payer uneasy. Right? Because if you're paying for the policy, you have no control over the cash value, nothing. You have no control over the beneficiaries. You can't even call and ask questions. All you're doing is paying. You're not going to want to pay for a policy that you have no control over, especially if you don't know me.
Right.
Because I'm going to change, if you're paying, I'm going to change the beneficiaries. You're not going to know. The insurance company can't contact you.
Exactly.
So what they do is they limit who can own the policies. They even have issues at times. They want to know that you have some invested risk. Does this person live with you? What loss are you going to have if this person dies? They're not just letting you get, even with siblings. If your siblings are grown, they're going to be like, why do you need to own the policy? Why can't they own it? No, they need to own it.
I heard about something also where companies or just individuals were preying on the elderly. Right?
Oh yeah, they do that.
And maybe not just praying. Let me explain. Y'all tell me how y'all feel. Think of it like someone in their 60s. They don't have life insurance. They don't have any money. They didn't really live life to the fullest. Mm-hmm. A gentleman, a female, a company, they approach this elder and say, hey, listen, maybe another 30 years you'll be alive, maybe less. Take $100,000. Here's $100,000 cash, and let me put this policy on you, right? For the investor, it's $100,000 up front. On the back end, 20 years down the line, 30 years, who's really living to 90? Not too many people. So if you're 60 and the risk, I suppose, is low, you know, they check the whole vitals and everything. $100,000 up front means $900,000 on the back. So how you feel about something like that? Is that
sounds like a good deal?
You know what I mean?
Because if you have no money and you messed up,
companies are not allowing you to do that if they know, right? That's why they have the question on there. But of course, let me tell you, at the end of the day, you know how things go. There's many ways around all of these things, because if nobody's telling the insurance company and answering that question no,
right,
then if I'm the only issue is that investor has to trust this person, because the insurance company is not going to let them own it.
Right.
Because there's no insurable risk. So they're not going to let them own it. So that's where the problem is going to come in with that, unless you can get policies when you have a business with somebody.
Yes.
Now, if they happen to start a business with this person, right, now things are different. So if we're a business, you know, we can set up a buy-sell agreement. We back it up with the insurance. But of course, these are other.
Let me impress you, because Mom Duke said, ask him if he read the book. I did read the book, and that was probably one of my favorite chapters of the book. It's 3 types of life insurances that you should have as a business owner. 1, of course, your personal life insurance. It protects your personal finances and your family. 2, key person life insurance, right? So key person is basically a very influential part of the business. Like, say, for instance, you and I, we're a team. If I leave, I'm a key person. You can't do this show anymore without me. This may take some time for you to rebuild it, hire, train, get somebody else to replace me. So that insurance policy covers that time that I'm gone. That loss. Then 3, the buy-sell agreement, like she just mentioned, which has a 2-part to it, which is cross purchase and entity purchase. Okay. And cross purchase is when you and I put life insurance policies on each other. So if anything happens, you put it on me, so you're the beneficiary of my policy, yours, and vice versa. And then the entity is when the business itself is paying for both of our policies.
And they own it, and they're the beneficiary.
Yes. Oh, man. Put your hands together for that breakdown.
Come on.
You guys can't hear the applause, but it's applause in there. Listen, he read that fast. I don't know how he retained all that.
He did a really good job breaking it down.
That's why I let him read the menu when we go to restaurants. You know what I'm saying? He understands all the ingredients.
But that's great stuff, though, Linz. And for us, we're business owners, and that applies. Like, right now, we should all have that as business owners.
And really think about certain businesses where you really need it, where it's really a big loss, especially real estate, right? Because if you guys partner up and own real estate together, and you guys are both funding this real estate, and now one partner passes away, you now have to fund it 100% by yourself. You also got to take care of all those mortgages by yourself. All that debt becomes yours. Now, of course, the big issue is he got beneficiaries. They want his half. So not only do you have to come up with this money because your business is currently going on and you have taxes to pay, you got the boiler messed up at a place, you got things to furnish, right? The other part to it is you about to give half of this to his beneficiaries, and it may not be half that's liquid. So you might have to sell some things off, because me as his child is saying, I don't want no part of that business. I got something else to do with this money. I need my money. So if you don't have an agreement put together and have the insurance back it up, you could have some serious issues. So it's important for us to make sure that we're covering our business as well.
Absolutely.
And listen to this part. So you can either cover the business in term, which we know is a temporary product, doesn't build any assets for you, but it'll cover risk management. But we can cover it with a permanent policy. Now, let's say the business wants to expand. Well, guess what? We got some cash value that we can use to expand the business. We could take a loan. So there's other things that we can do with this insurance besides just have it manage the risk.
Sure.
And that's where I want to flip it. That's a good segue. Let's talk about how you can actually use the money in your insurance, because I understand that's possible. I don't know the breakdown. People say if you have a lot of money, you can put a lot of money in up front, and IUL and what's the other one?
VUL.
VUL. And the difference is, we had a conversation downstairs. That was the battle, IUL versus VUL. Yep. So you're putting money into a whole life right now.
Are you talking about VUL, IUL, or whole life?
Okay, so let me back all the way up to the types of life insurance. Okay. We got the term down.
Got that
right?
down.
It ends. You can't take no money out of term.
Nothing.
Right. So term's over here. Then you got whole life. But there's different types.
Under the permanent insurance umbrella.
Under the permanent insurance umbrella is whole life.
Yes.
Okay. Whole life is you pay forever.
Not necessarily.
That's a question mark.
Okay.
Well, then respond to that.
Okay, so whole life, just like you have universal life, right, under the permanent insurance umbrella, there are many variations of it. So you have whole life policies that you could pay to age 100. You can customize it where it's a 10 pay. You only pay for 10 years. You can have single pay. You can do 20 pay, 15, 5, 6, whatever. Depending on the company, you can do any pay up to 30 years. In addition to that, you can also pay to a certain age. There's policies to age 65, to 85, 100, 121. The thing about it is, the shorter the pay period, the more money it's going to cost, the more cash value it's going to build, the fastest. Okay? So if you're looking to build your cash value fast, you're going to take a shorter pay period, and you're also going to have a higher death benefit. Okay? That's how you're going to build that cash value the fastest.
And you would do that why?
So if you want to use the cash value, then you're going to want to build it fast, because some people are looking to actually...
But if you have money, you already have money.
Okay.
So why are you putting a lot of money into life insurance just to use that money? What is the benefit?
Two ways. One way, it's going to get the compound interest, so it's going to build you money. But the second way is, when you die, it's going to pay out in a death benefit, but it's going to leverage. So you might have put $100K in here, but that might have brought you a $1.5 million death benefit. So where are we getting that kind of return? Immediately.
Okay.
Tax free.
So let me move this back. So are you saying if you put a lot of money up front, right, you could borrow a portion of that money from yourself?
Absolutely.
You could use that money to make more money, but that full amount is still in there giving you interest? Is that what you're saying?
Depending on the type of company, if it's direct or non-direct, yes.
Okay, so I just want to break this down slowly so everyone understands. If you have a lot of money and you put a lot of money up front into a policy, you can borrow a portion of your own money that's making a certain percentage per year. And it's, even though you took it out, it's still there in its full amount, making you that same interest?
So it's still going to gain the interest, right?
The full amount.
The full amount, if you're in a company that allows you to do it that way, because it's two ways. There are some companies that when you pull the money out, that the compound interest is only happening on the money left in there. So you wouldn't want to be with that kind of company. You want to be with a company that allows the money to be borrowed and still growing the interest, okay? But the thing about it is now when you take that loan, this money is still growing. So now when you decide to pay yourself back, and this is what I want to promote though, because a lot of people are taking the money out. They keep talking about taking it out. If you're going to keep taking, at some point you're going to need to start putting back. Because if you don't start to put money back, it's like a line of credit. If you just kept taking from the line of credit, eventually it's not there. If it eventually is not there, then you're going to lapse the policy. So yes, you can put a large amount of money in. Yes, you can borrow the money out. And yes, the money will grow while you have the money out. But there is an interest that's going to be charged to you for borrowing that money. Currently, most insurance companies are charging 5%. So, but the best thing about this is not a structured loan. It's not like the bank where they say every single month you got to pay XYZ. It's up to you. If this year you don't want to pay the interest, then you don't have to. If you want to pay it next year, you could do that whenever you want. But there is an interest being charged. If you do not pay the interest, then the other cash value that's in the policy, it will take another loan for that interest amount. So let's say your interest amount for the year was $500. At the end of the year, it'll take a $500 loan for that interest. You understand?
Nope.
Okay. So basically, I'm saying that any amount of money you take from your policy.
Just put numbers to it.
Okay, let's put numbers to it.
So I have $100,000 I put into the policy, and I borrow. How much can you borrow? First of all,
whatever's available.
I've heard all kind of stories about how.
So
much
I want to
really
be clear about that, because a lot of people think that 100% of what you're putting in, you could take out immediately. That is absolutely
They said
not true.
put 100% in 30 days, you could take 100% out.
No, it is true that depending on the policy type, in 30 days, you can take money out. It's not 100%. Typically, it may, and again, I want to make this specific, depending on the policy you get. So that means most times it's between 70 and 80% that you can take out in a specific policy, like a HEC V. That's a high early cash value policy. Some of the IULs, you could do it, the cash accumulation ones. Some of them, and I'm going to say it's not 80% out of there either, right? So again, it depends on the policy. But let's put numbers to it. So if I have a $1 million policy, and my annual premium to this policy is $15,000. So I'm going to pay $15,000 for my premium. And then in addition to that, let's say I dump another $10,000 in. Now, I want everybody to be clear. Although the insurance company will let you dump these amounts of money in, there is something called a MEC limit. If you go above the MEC limit, your policy can become taxable. So you want to make sure you are riding right under that MEC limit and whatever that number is. So let's say we dump in $10,000. Now you want to take money out. You got to wait for it to be available. So let's just say it takes about 30 days. Now, 30 days later, you cannot pull out $25K, right? Because a portion of that is paying your premium. So you can't take out all of the money. So you might be able to take out, let me see, out of $25K, let's say 70% of that you could take out if you have a HEC V policy. If you do not have that type of policy, you may have very minimal amounts of cash value you could take out in the beginning. You understand? So it all depends on the policy that you have. So when you hear online and they tell you they put all of this money in and they took all of this money out, it's either a high early cash value policy that they're taking all this money out, or they have an IUL cash accumulation focused policy. That's going to be a policy that's focused on building cash value, not death benefit.
So many people talk so much negative things about policies and agents and how certain agents are setting up your policy for their benefit, not really yours. Mm-hmm. So in that same example, if the max, or better yet, I need you to explain how we can max versus, you know, the premiums and how an agent could actually get off. How you can structure the policy properly. Right.
Okay, so that's key. So your agent does have to be well-versed on structuring a policy. That can take some time to learn. To make sure that the policy is focused more on building your cash value and not just being swallowed up by the death benefit, you're going to, need to make sure that you're using a policy focused on cash value. So that's going to take us to either the IULs that are cash accumulation focused. We're going to make sure that we typically level those death benefits, because if the death benefit's increasing, guess what? The cost is increasing. So if we want the max amount of cash value, we're going to need to make that death benefit level. Second thing that we're going to do is we're going to take the lowest death benefit and we're going to put the highest amount of premium we could put in there. So in that case, we're structuring it. So I just recently structured a policy for a real estate investor. They want to put $250,000 in for 10 years. Then they don't want to pay anything else. So I had to find a death benefit that will allow me to put $250,000 in
each year.
Okay. without it mecking.
Each year.
They're a real estate investor. Their purpose is going to be putting the money in, taking it out to buy property. With the first year of $250,000 in, they were only having access to $130,000 year one after the first 30 days. Okay. But year two, it was almost like double that. Right. But again, year two, you're at $500K.
Right.
Okay. So you got to be mindful of that. But the whole thing, we leveled the death benefit. The death benefit was like 3.7 mil. This person is 53 years old. Okay. So because of age, that's why the death benefit is not super high. The younger you are, that death benefit would have needed to be higher to hold $250,000. Because remember this, when you're getting these policies, it still is life insurance. So it has to be a premium that you're paying. So you can't just dump $100K in and then you can't afford no premium.
So $250, what's the premium on $250?
The annual target premium was $102,000 a year.
So if he wasn't dumping it all at that time, he would have to pay $8,500 a month.
Yep.
And then you allowed him from 102 basically to put an additional $148,000 in that policy.
Right. And that was because we leveled the premium. And what we also did is I only have him paying for 10 years. So that's minimizing the amount of premium that's going to make it mech later. So what it is when you look at a policy illustration, it's going to tell me as the agent, it's going to say this is the max amount of money you could put in this policy in a lifetime. And so I have to figure out how many years based off of what you want to pay. So it takes me to do some playing around with it. It's not like I just do it and it's going to come. I got to play around with it and put it together. So if you're an agent that doesn't know how to kind of play with the illustration system, you're not gonna get the best solution.
That's one thing I do know. There's no cookie cutter method for setting up your policies. Everybody's different. Everybody's situation is different. So you definitely need a great agent to put that together.
You do. You need an agent that, and this is the thing. So if you're an individual looking for an agent, depending on what your goals are, there's specific things that you're gonna look for in this agent. You can't, if it's a new agent, there's a lot of stuff that they're not going to know just yet because this comes into complex planning. The complex planning is not the same as a transaction of me you said you want 50,000 whole life. Okay, I write that policy. This is different. I have to start doing some complex illustrations. And that takes time to learn because I mentor agents and I teach them illustrations all the time because it's not simple when it's a complex individual. Transactional business is easy. You want 100K, you want 1 million, I write that, that's nothing.
Right.
But now you want the most cash out of your money with the least death benefit, we got to play around with that. And if you have certain numbers you want to reach, you may be somebody who's saying, I want to use this policy. We were talking about strategies, right? What we could use these policies for. Another option is for retirement planning. Use it as a supplement retirement. You can take a tax-free salary out of your policy every year if you would like to. So if we use, let's say, the first 20 years to grow our policy, and we take the next 20 years to collect a salary tax-free out of it. I'm going to give you an example. I did a presentation the other day. I showed them a 40-year-old, $1 million policy. Premium was $17,568 a year. Okay? So this person paid from age 40 to 65. At age 67, they started to take out a salary for $83,000 a year, tax-free, okay, for 20 years. So do the calculations. You only put in $17,000 and change. I'm giving you $83,000.
What?
Okay, now you do this for 20 years, and guess what? At the end of that illustration, there was still $1.1 million in death benefit left. Now, the reason why I'm saying that, because somebody might say, well, why are you saying that with the death benefit? Because the cash value, when you take a loan, deducts from the death benefit.
Right.
Okay, so I want you to be clear that when we're taking this money out, we're not paying this back. This is a retirement plan. So it's going to start to lower your death benefit.
Right.
So if your death benefit had grew from $1 million to $2 million, the reason why I'm saying you're now left with $1.1 million is because we've taken out this money.
Can you have multiple policies?
You can have as many policies as you can afford. So a lot of people, it's a misconception. People think, oh my goodness, I have a policy, I can't have this policy. No, that's not true. You can have as many policies as you want. You can have them with as many different companies. You could do different agents. You could, whatever it is, you just got to be able to afford it. So if I have a policy with me and then I also have a policy with you, it doesn't matter as long as I can afford it.
Right. I like that. I like that play you just ran with the, was it a 40-year-old?
It's a 40-year-old.
Yeah, that's what I'm about to run that
That's
plan.
a nice play.
That was a 40-year-old.
That's a nice play. That's like the buy, borrow, die, where, you know, you buy the assets, you know, you grow the equity, you borrow from it, and then when you die, the policy pays back all of, you know, the debt on the policy or on the real estate. So that's clean right there. That's really clean.
It's a really good retirement option, especially because they have a product that you pay to age 65. So imagine you're 40 and you pay a product to 65. You have no premiums due. Your policy is still building cash value, still growing death benefit, and now you can use it as a supplemental retirement option. It's an amazing product. People have so many negative things to say about these products, but I always say, do what's best for you, because for me, it's been working. So I don't know.
What's your hack? Your personal hack? How are you maneuvering? I know you do it for others, but like, what's your plan? How are you using these policies to your benefit?
So I have quite a few. I think I'm at 12 now, right?
Of course.
I'm at 12 now. Actually, my primary residence, I've just been renovating for the last 2 years. I mean, finally we're coming to an end. But I actually borrowed $50,000 from it to use for the property because my expectations of what this property was supposed to cost was way beyond what I was originally supposed to be spending. So I actually borrowed the money from my own policy. Mm-hmm. So what the thing is that you have an asset here that you can use at any time that you would like. Yeah. I also have another one that I'm not touching that's specifically going to be for retirement. But my goal was, and my daughter has significant policies as well. And so remember, didn't I say before, when your child has a policy, you own that money. It's right. My money. Mm-hmm. If I decide to give it to her, it's her money, right? But either way, when I die, she receives a death benefit, right? Which I have term and I have whole life. Me personally, I don't dibble and dabble in the UL policies. I'm not a big risk taker, okay. Right? And the UL policy is a flexible premium. And it is a chance that the UL policy cannot last your entire life. If you do not pay the correct premium, that policy will eat itself.
Wow.
Not to say that whole life can't, but in whole life, it's a fixed premium, and the premium is set for it to guarantee you the death benefit.
So there's no limit on the IUL?
What you mean there's no limit?
Like, you're saying it's variable, right? Mm-hmm. So you're saying it's risky. I'm not getting...
Okay, so the reason why I'm saying this is risky, the IUL is really caters towards a certain person. I would say an IUL is going to cater to an individual who is able to keep increasing their premium over time. Somebody who either wants to dump money in, somebody who's able to pay at least the target premium. Remember, IUL is a flexible premium. There's a range in premium you could pay, from a base where it's considered a no-lapse guarantee premium all the way up into the MEC. You could pay anywhere in between that. If you choose to pay close by the no-lapse guarantee, that typically only guarantees you about 20 years. What if you live 40 years? Also, if you don't pay the target premium, it doesn't even get you to age 90. unless you've been overfunding this policy. Again, going back to structure, right? If the policy is not structured properly, it can end on you. And it used to happen all the time, which is why back in the day, I didn't like to sell it, because so many people who were older had those policies in their 30s and 40s, and back in the day, they weren't structuring it properly. If you said you wanted to pay the minimum premium, they let you pay that. Guess what? It lasts 20 years, 15 years. It was gone. The interest back in the day was so high, it was running them close to 80 and ending, right? And people used to illustrate the policies back in the day at 8%. It's not realistic, right? It's not consistent 8% every year.
Yeah, that's the number I always keep hearing.
Yeah.
Yeah, if you first of all, now they don't let us illustrate it at that anymore because it's so misleading. It never, ever, ever looks like that, right? So a lot of times now you'll see the illustrations at 5.1%, 4.5%. That's more realistic of what it's going to be. So this is what I want to tell you about IUL. So everybody will tell you about how great it's these 22% years. First of all, majority of the IUL companies have a cap. So you're not getting that anyway. Most of the caps are about 9.3, 9.8. If you're in the state of New York, 6%, right? So it doesn't matter if it got 22%. You didn't get it. And then also, the other part is, so for the years that you got the 0%, so they say, oh, it's safety because when it's negative, it's not negative for you. True.
Yeah, the 0% floors.
Okay, but who wants 0%? Remember, there's quite a few years you get that 0% in a 20-year span. Right. So what does that mean for you? Part of the reason why I stick to whole life, right? Yeah. But that's the thing. So the IUL is for people who like to play with that risk. It's not the same percent every single year. And don't get me wrong, if you structure an IUL properly, where somebody's overfunding that policy, it could be beautiful. It could be it, and it's gonna be more cash value than you have in your whole life policy, for sure. If you're structuring it focused on cash value, because you can put way more money in there than in the whole life because it has the range of premium. And the whole life's premium is fixed. It's already a higher premium kinda. So the IUL is something that always people got the bright eyes. And then you have all these people trying to tell you, oh, 10%, 20%, 15%. They throw these numbers out there. And it's like, you're making it seem like somebody's getting that every year.
Right.
That's not the truth. So I'm very honest when I sell IUL, and I say, which client are you? Are you an IUL client who likes risk, who wants the flexibility because you're probably an entrepreneur, who also understands that at times you may have to dump some extra money in there to make this policy thrive? If you like that, if you like the fact that when times are rough for the business, you don't have to pay the premium and it could still live for a little bit of time, then UL is your situation. If you're a client who wants to know for sure exactly what your premium is, know exactly what your death benefit is, and you don't really want to micromanage your policy, you're a whole life client.
How is there any specific person that you would recommend term for?
Yeah. Anybody has any temporary solutions. People who have mortgages, people who have young children, people who are covering shared debt. Let's say we're married and we co-borrow. I die, that's your debt. But it might have really been mine.
Sure.
So I'm going to get the term policy and I'm going to cover that. If I'm a co-borrow with you, we're going to get a term policy. I'm not going to be left with your debt when you die. Doesn't make sense for me.
Right.
So that's the reason. But really, term is to replace your income. It's the most affordable insurance. So you can replace your income with term. People always are like, oh, I don't like term. It doesn't make you money. Well, does your house insurance make you any money? No, but you have it because if you have a fire, then you have to pay for your house being burned down, right? It's risk management. Your car insurance, you pay that. Are you getting any money back because you didn't have an accident this week? Nope. And you have no problem paying it because when you do get in an accident, Everything is taken care of. That's what term
you
is.
You should get a little bit back, though. You don't get in the accident. You've been paying for 20 years. You never had a fender bender. It's like, come on, hit me with a little, seven grand or something. Like, I've been paying this forever. You know what I'm saying?
But it's risk management.
Right.
So insurance across the board is typically to mitigate risk. So you're just lucky that these additional policies are allowing you to mitigate risk and also get an asset. So term is just not that. Term is just mitigating risk. But guess what? It's so cheap. It's so cheap compared to the other options. Right? And so the other part about the term is, some people will say, yeah, but it's a waste of money. I said in hindsight, it's a waste of money. Because what if you didn't live? What about the person who died on the news yesterday that was 22? So that's how you got to look at term. You can't look at it saying, but I know I'm going to live. I mean, everybody thinks we're going to live, but that's just not the stories that are out here.
And just sitting here thinking about how every insurance policy is promoted during a purchase. Like when you buy your car, right? You get your auto, you go to the dealership, they're like, yeah, you got to get some type of insurance with this. You go buy an iPhone, they're like, would you like the iPhone, Apple insurance?
No, that's for everything. You know what I'm saying? You could buy a camera. There's insurance for everything you buy.
Everything. Now. When you're on Amazon, it pops up.
It pops up
for everything.
But there's nothing popping up for no life insurance.
So you got insurance for your vacuum, but you don't got life insurance for you.
But this is the thing. Where is it popping up at? Like you said, we don't know. 76% of people don't have it. But all other insurances are popping up with a purchase that you're making. Your home insurance, PMI's right there. Auto loans. They're like, yo, you can't even pull off without insurance.
Right.
You know what I'm saying?
Right.
So when you're born, why ain't they like, hey,
we're the insurance people before you leave the hospital for $10 a month?
No, it's very true. And think about that. Why are y'all not promoting life insurance? Why is it like this secret?
Yeah, but why wouldn't they? They make money. It's a life insurance company. So now I'm really confused.
But I also feel like it's a missing part to your financial portfolio. And we lack in finance in our community, right? Because we don't hear about it, but in these other communities, that's all they talking about. I have some clients that don't look like us, and before the babies are born, they're calling you, listen, granddaughter's coming soon. I think we're looking at July. We're gonna we're gonna need a policy. Start letting me know what it's gonna cost for $1 million. Like, these are things that other cultures are doing. They're having these conversations. So it's just that we're not having these conversations in our community. So we think it's not out there. No, it's out there. It's just not in front of our face. And we don't fully understand it. And when you don't understand something and realize the value, you don't want to spend your money on it. So yeah, I'm going to go get the Chanel bag and I'm not going to have insurance. Because the Chanel bag, I see the value when people wear it. I think that it means that it's value, right? So I'm going to spend money on that. The life insurance, I want the cheapest amount. Can I get $15?
Right.
Can I spend? Because I don't see it. You know why? Because my parent didn't leave me any money. My grandfather didn't leave me any money. When somebody in your family leaves you money, you will forever be excited about life insurance. Because you know the feeling of receiving money that you never worked for. It's just tax-free check that you receive. Today, I write you a check for $1 million. No strings attached. Are you excited? That can change your life. You might have had debt. You might have wanted a property.
My mom said, you got $1 million on me? Cause you know what I'm saying? What you got for me? You know what I'm saying?
Yeah.
But I'm serious. It's life-changing.
And you made a point we were talking about earlier where I can't just be the payer and the beneficiary, even if like it's a family member, right?
Right. So what it is you can be the payer. That person who is the insured would have to decide on who the beneficiary is. So if you guys decided that you're going to be the beneficiary,
right,
cool. But you don't know when that person decides they don't want you to be the beneficiary anymore and you're the payer. Because as the payer, you don't receive any information.
Is there any way to lock it in Whereas though now we know like our family trust is the beneficiary of this policy.
So if somebody has a trust, then of course you can make the trust the beneficiary. But the person who if the trust doesn't own it, and let's say the individual still owns it, they can make changes whenever they want. Wait. You can change the beneficiary as many times as you want. It's not a limit on that.
And you can't be the beneficiary of a policy you're paying.
Yes, you could be a beneficiary of the policy.
So what if I'm paying a policy?
Okay.
I'm the beneficiary.
Okay.
And I identify as dead.
No. You said you being no. You can't be the beneficiary of your own policy. No.
Because I was gonna say I can identify as dead.
No, absolutely not.
Absolutely
not. And most insurance companies
trying to find the holes there.
They're not really even gonna let you write the policy without putting a beneficiary. You know, it's very common that people feel like they don't trust anybody to be their beneficiary.
Right.
And and they're a minor, they don't get that money until they're of age. Now, of course, it's going to be a lot more money because it's going to get interest, right? Because it goes into escrow. But who's going to take care of them, right? Because the purpose is to save them from financial loss. They're going to have financial loss as long as there's no money that was left behind. But you have people who don't want to pick another beneficiary. They're like, just my kids. And I'm like, well, your kids are 2. So they got a long way to go before 18. We got to find somebody.
Nobody else is going to be able to answer this question but you. I got to ask you. So let's say I got the policy for my child, or I'm paying for the policy. He's the beneficiary. My child's the beneficiary. All right, I pass. But better yet, he passes. My child passes. Now, who is in charge of that money? Where does that money go? Because I know you just said it goes in escrow. How... Or does it just stay in escrow until somebody claims it? Like, how does that work?
Let me go back. So you passed.
I passed.
And then your son passes before he gets his money.
Correct.
So his estate will receive that money. And obviously, if there's no planning that have been done for his estate, then the state is going to decide who is going to receive that money.
Next of kin.
Right.
Okay.
Exactly. So based off of their rules in that state of who what's the order, they're going to check for those people, and that's how they're going to disperse that money.
And that's the probate process?
So
similar to the probate process?
Well, with the probate process, obviously, I mean, now the probate processes are taking so long. But the probate process, obviously, in that time frame, people are fighting. This one is like, I think it belongs to me because I was close to him, and this, so until that's settled.
And that's why you want to trust, right?
Right. That's why you want to trust. So a trust avoids probate. But the other part about the probate process too is in this scenario where there's an estate just kind of sitting there, right? Because now it's a new problem,
right? Because
you have a minor that passed away. So now that estate is going to kind of just sit there until there's somebody to give it to, right? Because somebody got to come for it, right? So I'm not really sure fully in that situation what would happen if there's nobody, because it's going to have to wait till whoever's next.
Yeah, and then most people don't even know it's there. It's probably a lot of unclaimed funds out there. You know what I mean?
Well, they have that website that you could check.
Unclaimed property?
For the unclaimed funds,
yeah.
Wow. Well, listen.
Serious.
You do good on social media, but this was real good.
This was serious. I didn't know you was this deep.
Yeah, this.
Like, I'm like,
I usually make
drop bars. You know what I mean?
Y'all are so
I'm usually way more wild. I usually make way more jokes.
Yeah.
It usually gets way more crazy. But I was just here like,
this was great.
Everybody, listen. Everybody needs life insurance. Everybody. Immediately.
It's got me thinking, wow, right now.
Because that has nothing to do with your age. It has nothing to do with your age. It has nothing to do with where you're from. So remember, life insurance is to protect your life. So your life can end at any point. There's babies that live for 5 days.
Wow. So,
Right?
so
That's true.
wow. Well, as you can see or hear, ladies and gentlemen, if you need some life insurance, we have a professional
Absolutely.
who's here for all your needs.
Yeah.
And she is the legacy creator.
Yeah.
Yes.
And
check out my t-shirt.
Good Lord. I got school today.
Oh, don't forget the book now.
Don't forget the book.
Yeah,
This
I
is
need
on
a book.
Amazon.
Creating Wealth Through Life Insurance. It's
How many
available.
agents you know got books out?
That's fire. I need a signed copy though.
I got you.
Damn. So Lindsay, you have anything you want to plug before we take her home?
Absolutely. So one, my book. Everybody grab a copy of this book. Especially what I did in this book was make it.
What's the title?
It's Creating Wealth Through Life Insurance by Lindsey Smith. And the reason why I did the book in the first place was everybody says they don't really understand life insurance and how everything is so complex. So I really simplified it so that your second grader who can read this book, right? I didn't use the words that's going to make you feel like, what the hell are you talking about? Oh, sorry.
You got the audio version too?
I don't. Actually, I just spoke to my publisher about that, and we're getting on that. I'm getting on that.
Are you gonna narrate or are you gonna pick?
No, I'm gonna have somebody.
Okay.
I don't want to hear my voice. So now I'm gonna have somebody do it. Also, I have the merch, guys. Legacy Creator. T-shirts and hoodies and hats. Get with it. It's on my page.
We need
Lindsey
socks
Smith.
too. We need the socks.
Ooh, you slacking on the socks. That's hard.
Everybody slacks on the socks. They always forget about the socks.
They do. And that's a sale right there.
Oh, yeah.
Yeah, that's a sale. That's true. Mm-hmm.
Wow, well, you heard it here first. You know what I'm saying? Prada, anything before we go?
Nah, man. Listen, you know me. 3-step process. Build the credit, fix the credit, get the funding, but you can't forget the life insurance.
This is what I'm saying.
You cannot forget the life insurance. Nah,
Yeah,
man.
I mean, I got a little term, but now it's like, okay, this is part of the monopoly board.
Yes.
It ain't just about the income and everything else. This is part of the monopoly board.
Yes.
It's a must-have.
They say get a lawyer, get an accountant, get a credit guy. Where's the life insurance?
No, they tell you get a life insurance person. They tell you that too.
Well, they need to say get Lindsay.
They need to
That's
say
what they
get
should be
Lindsay
saying.
if you want to get right.
Right.
I'm saying.
Ladies and gentlemen, life with Lindsay. We had a great time.
Yes.
We had a great. If you can make money over that, I want 10%. We had a great time. Thanks for coming out, and we got to do this again.
Thank you for having
We're probably
me.
gonna have a live event. We need you to be. This is crazy.
Yeah.
This is crazy.
I'm ready. I'm always ready. Born ready.
Yeah, no, for sure.
Well, Porter vs. Prada. We'll see you next time. Get it.